let's find out what's happening with oil prices now and other top commodities. Joining me now, we have Dumebi Oluwole, manager at Financial Derivatives Company. Great to have you, Dumebi. Good morning. I guess we were kind of expecting what we're seeing with oil prices. Seeing what played out last week into the weekend. So now we've had two consecutive sessions of declines. Do you think this is based on this improving flows, through the Strait of Hormuz, or is it something else, that we're not seeing?
I mean, all the cards on the table. The first thing that we're of course considering right now with the trending oil prices is the progress on the US-Iran, talks, and the fact that they have signed a memorandum of understanding and are looking to ensure that there's a level of, of implementation that happens within the next 60 days. The markets are of course pricing that in, and that's one of the reasons why we're seeing oil prices fall. There are risks as well to that, deal actually pulling through, or the agreement even seeing the light of day. On top of the conversation is, the war strikes with Lebanon and Israel. That is, of course, on the table. There's conversations around on freezing, all of Iran's assets that have been frozen since the 1980s. So that's, of course, on the table. And there are conversations around that, frozen. And if all of it is unfrozen, again, like I mentioned, there's a risk on there because the markets are not necessarily pricing in that all of the monies and all of the assets of Iran would actually be unfrozen. Then the final risk as well is, Iran continuing its uranium progress and program, and them of course continuing, coming to the table in terms of nuclear arrangements, just like other countries that we're seeing globally, take on that stance. So I will say that that's like the major, factor really affecting global oil prices. The risks as well are still there, and that's why we're seeing oil prices dance around $80 per barrel. And I guess the major implication, or what we can watch out for, is number one, oil prices, the markets will definitely remain unforgiving, and oil prices will likely, keep trending downwards, like you have rightly pointed. And the forecast right now is around $75 to $85 per barrel. Oil prices actually retaining that trend. The second outlook here is that the risks that we see that I've mentioned do not escalate. The expectation here is that all of the parties and mediators, including Qatar and Pakistan, help ensure that the communication lines between US, Israel, and Iran remain strong and the mediation remains progressive to ensure that this risk that we have, highlighted doesn't necessarily see the light of day. And I guess the final outlook here is what this means for the broader market expectation and especially monetary policy. But I'm happy to check if you have other questions. I've not been speaking for a while.
It's quite interesting because, when you look at the geopolitics of it at this point, the U.S., they had plans. That's why, they had to, go through the route, and, we had to see the impact on, oil prices rising, so high. But looking at Iran at this point, we're hearing, some segments there in the U.S. saying at this point, Iran won, that the U.S. did not get exactly what it wanted because they still have, their enriched uranium at this point. Sanctions are being eased. Their oil exports are resuming that were not there before. So how's it looking in your view? Who's winning here?
Personally, I'm not really sure it's about who is winning and who is not. I think the facts are this was a war of choice. It was a highly unnecessary war. We didn't have to be in this position. The world didn't have to take the hit, and that's exactly why it's seeming like, Iran is winning. And I will say that based on the fact that we know that this is a war of choice and the world has experienced uncertainty since 2020, I think that most analysts and even the rest of the world, especially emerging and frontier markets, are beginning to reconsider, alliances, are beginning to reconsider their competitive advantage, their comparative advantage. And this just for me means a new global order. And I think I've been saying this for the last, 3 months or so. And it's just generally because I think that this is the case, not because the US will not remain a prominent or global will not remain a prominent or global economy, but I do think that at the middle of the pyramid, where you have a lot of emerging and frontier markets, I do think that a lot of conversations will continually happen. I think that we would see a lot of intra-regional trade, regardless of religion, regardless of beliefs, between emerging and frontier markets. I think that commodities like crude oil will definitely remain, top of mind, but that strong shift towards renewable energy would now intensify simply because, the markets and countries have seen how vulnerable they are to the dance in oil prices and how that dance typically stems from uncertainty, which over the last 4 years or last 3 years has highly, and strongly come from the United States. And the final thing that I do see is a very big thing to point out here is that beyond trade, I think that conversations and pressure about security, international relations, and international development within the UN would now become a very, very significant and burning issue globally. Why? Because a lot of emerging and frontier markets that have been excluded from the decision table over the last 3-4 decades and now beginning to spring their voice in unison to ensure that they have a say in the matters that typically affect them. And that involves, of course, Africa, involves Latin American countries, it involves small island countries like Barbados, and these conversations are already happening. So for me, it's beyond who is winning and who is not. It's just a matter of the fact that, number one, it was a war of choice, and number two, it has really open the ground for a lot of new alliances to happen at the middle of the global strata.
Right. I guess you're telling me that I paid 1314 for fuel for nothing, because of this war. That's what you're telling me at this point. I guess the number one loser is the consumer at this point.
Yes, I definitely agree. And I think that that's where a lot of conversations around the big risks of geopolitics really comes to play here. Industries, business owners and consumers are always, at the back burner and always the hardest hit when, things happen globally and even domestically. And that's why there's a lot of conversations now about the importance of, consumers, business owners being involved in civic building, simply because a lot of the decisions that are made by the political class extremely affects how they run their businesses, how people are able to consume, how people earn money, how people spend money, and the quality of life, which is extremely important of course, everyone, right? So I think that that's of course the very beginning. And what this really brings to mind for me when it comes to the conversation around consumer spending is the developing markets, right? So we've seen a significant shift in how people are consuming over the last decade. And now that we've seen shocks back to back from 2019 up until 2026, it means that consumer wallets are playing catch up, right, to how quickly things have changed, how prices have escalated. And more importantly, we're also seeing the policy environment play catch up as well. So it's almost like a rat race to ensure that things become stable. And not until countries begin to focus on the commodities and policies and even the politics of comparative advantage, I think that developing markets will continue to struggle whenever there's a lot of vulnerability in the global space. Bringing this home to Nigeria, I think that we've seen this happen so much, and of course it brings to mind the fact that, number one, there has to be stronger institutions in Nigeria. Number two, Nigeria has to focus on, again, comparative advantage and ensure that the key economic resources that we have at our disposal, we are adding value, and it's not just going to happen from the top. My theory is always speaking to comparative advantage from the subnational level, where individual states take advantage of the resources that they have to ensure that they encourage, investments. Number two, they also encourage good and quality life, and more importantly, they are able to, improve their internally generated revenue. And the final thing, of course, is there needs to be more policy, cohesion from the monetary and fiscal side, ensuring that there's a lot of monitoring and evaluation that comes to play, and ensuring that every policy that we make, of course, the public have, strong stakes in it and are involved in the conversation. There's transparency across the board, and this is where I stand pretty much on how we can somewhat solve this gap from global to domestic to consumers.
I guess the oil producers, they had a good time, with oil over $100 per barrel. Good for government revenue. We did see, FAC, swell up. The Naira, how's that, translated into the Naira? Is it quite stable, though?
Yes, the Naira has been quite stable. I will say it's beyond, oil prices right now, or the increase in Nigeria's oil production, simply because in the period where we did see the shocks of the war and oil prices significantly increase, that's between February and March, Nigeria's crude oil, from the NUPRC crude oil data was actually around 1.35 million barrels per day, falling from what it was in January, which was around 1.4 million barrels per day. But between April and May, we've seen oil production actually pick up to average around 1.5 million barrels per day. So more importantly, I think the reforms that Nigeria has been taking, the increase in FX reserves, the increase in market transparency, of course the increase in FX supply, we've seen all of that support the Naira stability, ensuring that Naira remains resilient despite all of the shocks that we have seen. I also think that beyond what the Naira is trading at, I think the key factor here is that the resilience of the monetary policy environment right now in Nigeria is of course encouraging more inflows, encouraging investment appetite towards Nigerian assets right now. FPI inflows have significantly surged over the last 6 months and even the last year, and the expectation is that that will continue, considering that monetary policy now is more orthodox and there's stability in FX supply and there's transparency in how the market is trading. I expect this trend to continue, expecting that FDI inflows would also follow suit as we head into 2027, 2028, and I think that would be the case for the Naira. So that has been the trend and the drivers, and more importantly, the outlook for the Naira in the near term.
Right, and how are you seeing the spread between the official and the parallel market? You see that's at about 30 Naira now.
Yes. Of course, that's a concern. But when you look at where we're coming from and where we are now, that's a significantly different environment. We're coming from where the spread was about 60%. Where the parallel market rate was 60%. Higher than the official rate. But now that gap has significantly narrowed. This doesn't mean that the trend that we're seeing now is not worth noting. It is, and I do think that over the next couple of months, the market will likely correct itself. We've seen strong demand and strong demand at the parallel market for FX, but I do see that the central bank is making efforts to ensure that gap is significantly narrowed, ensuring that more demand is, of course, moved towards the official market. And primarily, when you even check the quality of the demand at the parallel market, who exactly is demanding for this, you realize that it's primarily individuals. It's primarily individuals and less of corporate entities. So we expect that trend would, somewhat slow, and then the gap between the official and parallel markets would narrow in the next couple of months. If this doesn't narrow, of course, we've seen how big of a risk this is when we look at Nigeria, the FX market from around 2015 up until 2019, and that, of course, is a very big threat to the FX market stability. And I do not think that we will return there.
All right, talking about correction, we did see the local bourse now kick off this week in the green after dropping over 3% last week. We know investors are asking at this point, is this a major correction for the local stock market or just a blip?
I think if we, go a few months back to see where exactly the boost started from, excuse me, if we go back, a few months to see where exactly the stock market was, we see that there was a lot of frenzy, there was a lot of demand. The stock market was significantly rising. I think in 2025, it gained over 50%, right? One of the biggest and most best performing, stock markets, in Africa. I think that the market in itself is somewhat correcting. The frenzy around, the Dangote IPO, the frenzy around new stocks coming up, the frenzy around dividend payments, the financial services sector, doing its number. All of that is beginning to, subside now, and the market is becoming more stable. I don't think that we would see a bearish trend over the next couple of weeks or months, but I do think that market trading will be more sane. But I also expect that as the IPO comes up, that's for Dangote Refinery, as we head closer to it, the bubble will, begin to rise again, as the market, as retail and institutional investors begin to, gobble up that stock. So I think that what we are seeing is more around the market just, stabilizing itself, coming from where we saw a lot of frenzy, a lot of demand, and a lot of activities that was really propping up activities.
Right.
Yeah.
Yeah, I guess, investors, they have that Oliver twist in them. They just want to see it rising, continuously. Well, thank you so much, Dumebi Oluwole. Always great to have your perspective. Thank you.
Thank you for having me.
All right, let's get a check of what's happening in the global economy.